Hi, this is Sean Overton with OneStepRemove.com. In this video, we're discussing toxic order flow. Toxic order flow is jargon in the Forex industry for order flow that a brokerage or a bank doesn't want. And there are a couple of ways that toxic order flow affects them. More often than not, it's just the bottom line. They're not making any money or they're losing money because of a specific trader's behavior or trading actions, so they try and kill it. And whenever I work with people that want to sell expert advisors and they want to develop some sort of relationship with a brokerage, the first question out of the VP's mouth is what kind of order flow is it, or just directly, is it toxic? And toxic order flow usually comes from a handful of expert advisor types. Most of them are scalpers that enter and exit the market quickly. There are a couple reasons why quick trading affects everybody, but it's really down to the broker or the person that the broker is working with can't make money. I'm referring to the banks, and the banks they pretty much control Forex. There's only 10 or 15 that really matter, and if you're going to open a brokerage, you have to have a relationship with at least one of them, if not all of them. When most brokerages either try and make their own market or they pass the order flow through. Now, if they're making their own market, scalpers are irritating because they can't control their net exposure. If you're a small brokerage, maybe you want something like 10 million euros long on the euro-US dollar. And if you're trying to maintain that and somebody keeps entering and exiting the market with 2 standard lots every 5 minutes, you're watching your position size fluctuate up and down in a way that you don't want to, and it's because of one specific person. If you have a group of scalpers and they're all placing the same trades with the same EA, it's exponentially more irritating because instead of fluctuating by 2 standard lots, maybe it's fluctuating by 5 or 10 million. And that really catches their attention because they're no longer maintaining close control over their risk. Now, if they're passing the order flow off to a bank, it's a different problem. The bank has the same idea where they want to maintain a certain amount of exposure on the euro dollar and the pound, all of those different currencies. And if a certain brokerage is catering to scalpers, and those scalpers are entering and exit the market as a group, it affects the bank. Now, you probably wonder why would the Forex broker actually care about the bank? And the reason is because his business depends entirely on it. The bank is sort of the supplier of the product, and the broker is just the middleman. So if the supplier is upset and decides to cut off the business relationship entirely, it means the brokerage is either out of business or has to go desperately begging for another vendor. And that's very hard because in Forex there's really only 10 or 15 banks that matter, and it's a little incestuous community where if you tick off one, you tick off all of them because word gets around. So the brokerages will do everything in their power to maintain a solid, strong working relationship with the bank. And if that means irritating some of their customers, so be it. Now, the most famous example with toxic order flow is FAP Turbo. FAP Turbo was a scalper, but it had the more irritating problem of focusing on low liquidity markets, currencies like the Euro Pound or the Euro Swiss. And whenever the price would spike, which usually indicates low liquidity anyway, the EA would attempt to enter, and then it would try and exit 3 pips later. So you have this herd of several thousand traders trying to place trades all in the same direction, and when that market is only a couple million euros deep, and then you have 30 to 40 million euros worth of orders all in a split second, it just causes chaos. The brokers can't fill the order, the counterparty to that order doesn't actually want it, the servers get crashed because you have too many orders coming in at the same time, customers are upset because only 5 or 10% of them getting filled. Basically, nobody's a winner in that situation, and that's why it's called toxic. It's poisonous to the business. Nobody's making money. If you have questions about toxic order flow or how that might affect your expert advisor, you can find me at www.onestepremove.com. My name is Sean Overton. Thank you for listening.